Kenya's equities market is in a bear market. What does this mean for investors? Join me, Mugendi from Nabo Capital, as I discuss this. A bear market generally means that prices have come off from a previous peak by more than 20%. There are two market phases generally, either a bull market or a bear market, in between periods of consolidation. So a bull market on the flip side is when prices have risen by more than 20% from a previous low, and the opposite is true for a bear market where prices have declined by more than 20% from a previous high. So in bear markets, basically prices are trending lower. You do expect that generally the entire market is trending lower. You might find some stocks, some companies that have prices that are trending upwards, but mainly the prices are mainly trending lower. A number of factors have led to this situation that we're currently in. If you look at it globally, we had the invasion of Ukraine by Russia some months back. This exacerbated already strained supply chains. So we had an increase in food prices and also an increase in fuel prices owing to this phenomenon. So this has greatly impacted inflation across the globe. Inflation has really been a big issue this year. Even locally, the latest inflation print was around 7.1% against the upper, that's from the month of May, against the upper limit or the upper target, the upper band target by the CBK of 7.5%. So inflation has really been picking up this year, and it doesn't seem to be transitory. Owing to these factors, a number of central banks have adopted a tightening stance from their previously relaxed stance or their previously accommodative monetary policy. So a lot of central banks have started to raise interest rates across the globe, and this has led to some shocks in the market, basically fears about possible recession or slower paces of growth following the interest rate increments. So with interest rates rising and the central banks also tightening monetary policy, in order to combat inflation, we've had a lot of fears about growth. So a lot of growth expectations have had to come lower. I think global growth expectations by the IMF have come down to around 3.1% from earlier in the year at around 3.6%. So when lower growth expectations are priced in by investors, this factors into lower equity prices or lower risk prices in general. So with the interest rates up, and it also exacerbates the risk of recessions in some of these markets, and that has caused a lot of risky assets to decline in price. This does not mean all gloom for investors, however. Actually, during bear markets are a good time to accumulate fundamentally sound companies at quite a discounted, undervalued price, since the prices have come off quite significantly in bear markets. We looked at data back from 2008 for the Nairobi All Share Index, looking at the previous bear markets to just try and figure out where we are in our current bear market. From our analysis, we found that we've had close to 6 bear markets previously that lasted around 11 months on average, and where the decline was around 33%. We are currently we've already done 9 months in this current bear market, having started having peaked prices at end of August 2021. And since that peak, we have declined by close to 29%. So we're coming to we're almost at the historical average or at the historical mean, to say. So we do see that there's opportunity. There are a lot of opportunities right now, given the undervaluation that we see in the market. Specifically, looking at some of the sectors that we expect to do good during this period, we've noted that the Central Bank of Kenya has also increased interest rates, increased the central bank rate by 50 basis points to 7.5% from the previous 7%, also joining the monetary tightening bandwagon. This will also have quite some ramifications to the banking sector. We've seen the banking sector having released their Q1 2022 results, where profits have increased by on average around 25% since Q1 2021. This has been driven a lot by increased lending, as we've also seen the private sector credit growth average around 10.9% up until the end of March. So we do expect that should there not be a recession and economic growth to be sustained, the momentum to be sustained, that banks will continue to do well, given the fundamental drivers are still there, and they're also quite discounted in terms of price towards their fair value. We do also expect to see consumer stocks do well because they're going to be able to pass on the higher inflationary pressures towards consumers without much loss in market share. So there are a lot of defensive strategies that you can employ during this period to actually accumulate fundamentally sound companies and better position yourself towards the next phase of the business cycle.